I've seen tons of it. So
happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, where we roll through the last week that was in the mortgage industry. Each week, I bring on one of our mortgage lending members as my co-host to run through the headlines and talk through the business. And this week, in the co-pilot seat, the president of Western Ohio Mortgage, former Ohio MBA president, longtime friend, Teresa Rose. Teresa, great to see you.
thanks for having me. It's almost like I've been waiting for my prom date to call. It's like, is he gonna call? What if he doesn't call? Why hasn't he called? And finally he calls, like, yes, I'm in.
We need the co-hosts. So I should be the one worrying that you're not going to pick up. But either way, thank you very much, Teresa, for joining us, and looking forward to getting into it. So let's go ahead and do that to our attendees. As always, any questions, comments, thoughts anyone has for Teresa or I, please feel free to put them in the chat or the Q&A, and we will incorporate them into the show. Teresa, let's start with the big news of the week. The Federal Reserve meeting as we speak, getting set for 2 days in totality of meetings, which will conclude tomorrow with the release of their policy statement, press conference by Fed Chairman Jerome Powell, very wide expectation of another 75 basis point hike from the Fed, just a little bit of 100 basis point anticipation priced into the Fed funds futures market. A lot of economic data that's been out there, a lot of it inflation related. Our industry, the mortgage industry, fueling heavily off what the Fed is saying and doing. Teresa, your thoughts on the Fed, their meeting this week, and what might come of it?
Well, I'd say I've got a 50-50 chance of being right no matter what I say, because the economists are still split on where we're headed. Are we in a recession? Are we going to have a soft landing? I think Janet Yellen said still as early as last week, no, there's no recession. We're going to have a soft landing. But I think most people, most economists are still going a little more toward, yeah, maybe, I think maybe we're going to recession. So you got a 50-50 shot of being right. I think the only thing that would possibly really rock the markets is if there was any, maybe they do go to 100 basis points instead of 75, because it's kind of already being baked in. They expect, when you expect it, the market doesn't seem to have that jolt, even though we saw some pretty ugly, a lot of ugliness last month, but we slowly recovered from that, right? And a lot of times when there is evidence that the Fed's doing what they need to do to fight inflation, we see actually a more favorable take. Yeah, we'll have an increase in rates, but then it generally levels off, and sometimes that bond market's going to do a little bit better for us. But I think a lot of it will also depend on the comments. I don't know. It's kind of fun to actually watch those comments. I don't know if you watched last month, but actually Jerome Powell, he almost looks like what I call a long-tailed cat in a room full of rockers, because every time, somebody asks him a question, he's like, because he knows what's at stake, and he's afraid if he makes the wrong move or he says the wrong thing, that it's going to send everybody into a spiral. So I feel for him to have to make those comments, but you can see it in his face and the way he answers the questions, that he knows that we are at a very, very, very precipitous point in the economy, that everything they do is critical at the moment. So
it's a great point, Teresa. The weight on the shoulders of Jerome Powell and the Fed, to your point, one word that he states, or even the context in which he uses one word, or how he changes one word in a sentence when we get the Fed statement tomorrow, immediately analysts will be combing through it literally letter by letter, looking for changes from last month's statement. And to your point, yeah, he has the ability really to just roil financial markets one way or the other by freaking them out.
And then the media runs with it, right?
Yeah, then you get
they're asking questions.
Headlines, and Joe news consumer absorbs it the wrong way, and there you go. So I tend to agree with you that we could get 100 tomorrow. I think with Powell, he was clearly too passive in the whole inflation is transitory thing, and Now it feels like he's trying to be over aggressive and almost break the economy to fix it type situation. So we'll see. Should be interesting tomorrow afternoon to see.
Do watch it though. You need to watch him live. Just so it's kind of, it's not entertaining. I shouldn't say that it's entertaining, but just to see that weight and so you can draw your own conclusions too, because it's amazing to me what does get spun out of those out of those comments. The same way, with, oh, housing's down. In comparison to what? You read these headlines and you don't even know what they're referring to because of the reality we live in versus what, it's a slow news day and maybe a journalist needs to get a headline grab. So
perfect example. We were just talking about it right before we went live. I try to send out the show notes 24 hours in advance, and we're in a live news cycle. Obviously, we had the Case-Shiller report that just came out a couple hours ago. Our nation's most viewed and respected report on home prices, home values. The headline was home price growth slows dramatically 2 months in a row. The first sentence in the story, though, home values nationally up 19.7% year over year.
Right.
Last month they were up 20.6% year over year. Now we're only rolling along at a 19.6% clip. But yeah, it's your point, right? Like sensationalistic headlines.
Hey, if I can get a 4 or 5% appreciation rate on my real estate, I'm doing well. Though I will say, we do have to consider inflation against that, right? But if you're getting a 19% appreciation rate, why are you waiting? Anybody who says that interest rates is really the thing that's going to slow the housing market, I disagree, because I got in the market 40 years ago. When I got in the market, rates were like 16%. And people were still buying houses and financing real estate because there's a need there. And regardless of what happens, they're going to find a way, right? There has to be a way to get shelter for your home or for your family. So I don't think that slows it. It's funny because when you put that into context, I actually have a realtor friend on Facebook, and back in March, he was already starting housing market's cooling. I said, well, what do you mean by that? Well, there's less sales. Well, we have to take into consideration the cycle that we always have, right? So in the spring market, when all of a sudden they said, oh, there's more houses on the market than we've seen in a long time. Yeah, it's called the spring buying season. We always have it every year. It always increases, right? And so you see that, and because people want to buy in the spring, so their kids are in their school district by August, hopefully. But every little thing he would grab on and say, hey, the market's cooling. I said, who's your audience? Well, I need to tell my sellers, if they're going to sell, they need to sell now before these values go down. I said, but there's no evidence that home values are declining. We have too much demand for that. Just because there are less sales taking place, there's a lot of factors. Some of it's inventory, some of it, some people had to go into leases. The market was so hot, they couldn't find a property. They entered a lease, they're stuck in it another year. It's just a lot of factors that play into that.
Great point. There's this shadow inventory of people that want to buy a house that aren't actively bidding right now, or maybe are and aren't winning. All these people that if it's, in the parents' basement, or they have to lease temporarily, or I think that's what we're seeing right now. Like a lot of people with the run up in rates and the decline in inventory, bubble, everything's going to crash, and just wait 6 months, I'm going to get some great deal. What's happening now is what all of us that have been in the industry for a long time clearly saw what was going to happen, right? Inventory is eventually going to pick up a little bit, but you know what? Home values will moderate. They're not going to go down at all, because every house that goes on the market is still, okay, maybe it's getting sold in 10 days after 7 offers instead of 4 days after 20 offers.
Right. And I do think that some people have gotten frustrated and left the market, but they'll be back. It's not that they're gone permanently. People are getting squeezed so hard in rentals. I mean, they would be so much better off to have a mortgage payment than they would to pay a rent that they're paying now. And I've seen some of the things on the West Coast that actually floors me. I think they have like these San Francisco has these containers that you can rent, like you can sleep in. They're sleeping containers, and they're charging you $800 a month or something. It's just insane. So regardless, we know in the mortgage industry that that need is there, that no matter what you hear in the press, that we have probably 10 families for every house we have available, and then compounded with new builds, new starts. I mean, what do we do when builders are to a point of saying, listen, I can't make a profit on this property because there's just too much overhead, so I can't build right now. They're not going to build houses to take a loss. So how do we remedy that? You know, we talked a little bit about manufactured housing as maybe an option that they need to dust off, but how do we solve it?
This is the last week in Mortgage Today. I'm Rich Swabinsky with the Mortgage Collaborative, this week joined by Western Ohio Mortgage President Teresa Rose. And in the chat for our live audience, you can see the link to subscribe to our podcast, where majority of our audience listens. And got to do a better job in the middle of the show talking to our podcast listeners about joining us live every Tuesday at 2 p.m. Eastern. You can also watch the video recording of the shows on YouTube about an hour or so after the live recording concludes at 2:30 Eastern on Tuesdays. Teresa, you bring up a great point and good segue to where I was going next, and that is just construction of new homes in general. Piece that was written by columnist for the New York Times a few days ago that made some rounds through our industry. Going like 3/4 of the way there without actually calling for it, for the government to potentially get in the home building business. And the argument is basically this, which has some validity. Home builders, absolutely, we have a very bad housing supply issue in America, especially at the lower to moderate end. Home builders cannot make money building small, medium priced homes. Thus, we have a problem that is absolutely going to get worse. They pointed to other countries that, are involved in home construction and housing finance, even more than America. Your thoughts on the issue?
So, I have a lot of thoughts that maybe are not related to the government intervention of what can be done. Well, first of all, I alluded to manufactured housing, and that has been, as I called it earlier, kind of the stepchild of mortgage lending. We've always had a bias against it. I'm in Ohio primarily, and we do a lot of manufactured housing lending, and that could potentially be one of the solutions, but the lending criteria is tougher. There are additional requirements, but I think to maybe get that product out, look at it a little closer, see what can be done to make it a little more affordable on the lending side of it. The other thing that's a favorite of mine is renovation lending. So rather than concentrating on new housing stock, renovating the housing stock we have, the problem is right now, I know our company's doing a lot of education to realtors about the way they're marketing their aged inventory, their older homes. Every time you see their listing, it'll say cash or conventional only. When the truth is, there are a lot of buyers that could do a home style or a 203K loan and not only renovate that property, but potentially walk into equity. Because that's the other big thing we have. We have people out there paying over the ask to get in. So they're walking in with negative equity. And if they're getting an FHA loan, sometimes, there's really no equity there at all. They walk in, by the time they finance their mortgage insurance premium, there's nothing. But if they do a renovation loan, we frequently see that people are walking into equity day one because of the way those projects are financed. And, the fact that you're getting kind of like a new build feel without the new construction cost. So to me, I know that FHA is looking at their renovation product a little closer to see what they could do with it. I would love to see them maybe increase the, for those of you who do the limited 203K, maybe increase that from 35,000 to 50. So there's more room to have just a couple specialty contractors where you don't need a consultant to turn that inventory. So those are a couple things I personally think can be done to help with the problem. We know that we have the issue of corporate investors gobbling up houses all over the place. And our buyers, our first time buyers don't even have a shot at them.
Yeah, it really is an issue that needs addressed in some way. Just the housing stock of, if you're in Ohio, homes under a couple 100,000 and, just your scale, depending on where you live in America. On top of that, now there was another piece that came out by The Hill earlier, late last week, actually, just talking about some of the like realistic headwinds to some of the stuff in the Biden housing supply plan and general initiatives by the Biden administration and housing leaders to try to encourage local leaders to rezone land, to create more affordable housing units. And long story short, the piece by The Hill, which you can Google and read, it just spoke to it gave some real world examples happening all across America of just headwinds to this. And because it's tough to, when you're not talking about building new homes and redoing existing things, just dealings with the local municipality.
Yeah, I think that, so we have a similar situation here in our small town, where you want the affordable housing, but at the same time, you have people pushing against it because they don't, as they said, not in my backyard. If you want to build it, you got to build it someplace else. And I think the mindset is automatically to equate affordable housing with low income housing, which isn't even, they're not the same thing. And I know in our town, we have a builder, it's a nationally known builder that came in, is doing a subdivision. And I was shocked, literally shocked at the comments that were made on Facebook and social media about this new subdivision. People complaining about, oh, the quality is substandard, or somebody at the city must be on the take to even allow this to come in. Not understanding that, we all drive a different car. Some of us drive a Cadillac, some of us don't, right? Well, that's the same way with housing. If I want that new house and this is my affordable option, I want the opportunity to get that. I can update it later. If the siding isn't the best siding, or I want to make it brick, or I want to do something different, I can do that. They don't understand that entry point. And especially with new construction, it's very, very difficult for the builder to make any kind of money and still provide a nice unit for somebody to live in. It's really staggering just to hear the outside comments. And it's all about not in my neighborhood, not in my backyard. I don't like that because it's not as nice as what I think it should be. Well, we all have different needs, and people need to recognize and address it.
Not in my backyard, NIMBY, the acronym I've been starting to see and hear all across the news. And one I'm sure everybody will start to hear more as we get into the midterm election season, and with housing and housing supply and affordable housing, really evolving into what is going to be a fairly major issue in the midterm elections, and most likely the presidential cycle to follow. So something to keep an eye on. And staying with the federal government in their role in mortgage, Teresa, and moving our attention to FHFA and Fannie and Freddie. Sandra Thompson, who we've heard speak to our group a few times and seems to get it and care, and is trying to balance a lot of things tough, spoke this past week in front of Congress, and not a lot of breaking stuff there. Was questioned about the credit score model, FICO versus Vantage or something else, and appraisal bias issues that have come up. Review of loan level price adjustments and G fees, which she cited was, I forget if she said it was their number one priority to get done by the end of this year, one of their top priorities, something they're clearly looking at though. Loan level price adjustments, delivery fees, guarantee fees, how mortgages are priced essentially through Fannie and Freddie. Your thoughts on the GSEs right now, FHFA, and where that all stands?
So we've been talking about getting Fannie and Freddie out of conservatorship for 14 years now, right? It's every year. Oh, this is the year they're coming out of conservatorship. And of course, we've ran the gambit. I think at one point they were kind of a cash cow because I think they paid back like $100 billion to the government that they didn't borrow, that, you know, they didn't get bailed out of. So that was going pretty nice. I thought, well, maybe they're okay where they are. And then you had Calabria in there who thought, yeah, we just got to get rid of these guys altogether. They're bad news. We need private capital, which I think the non-QM space might be a good, poster child for what can happen when you're relying on private capital to fund mortgages, because it can go just so quickly, could just be gone overnight. Interestingly enough, though, so in all this, of course, you know, we're talking about credit score, and I don't really know how the timing of that works. If your goal truly is to restructure Fannie and Freddie's balance sheet, because they got to restructure the balance sheet, make sure they're on a strong financial footing. If you change the credit score model, it's not tested, because if you go ahead and you roll that out, now you've got mortgages that are going to be underwritten using those models. Might it change your book of business? Might it look different? So I'm not really sure how they time that, but something that I came across, I don't know if anyone has seen I think it's called Banking with Interest. It's a podcast. I think Rob Blackwell has. Mark Calabria was a featured speaker on there about 8 weeks ago. And as recent as 8 weeks ago, he was still saying, and I hate to throw this out there because boy, this is something nobody wants to hear, that Fannie and the window of opportunity to get Fannie and Freddie out of conservatorship, in his opinion, probably has passed, and that they won't make it. And he also said the same thing about FHA, that FHA's book was subprime, and they were headed for a bailout. Those were his comments. And if you listen, it's a 1 hour podcast. It is, I mean, it's not anything anybody else is saying, but he truly believes that we have a financial crisis in our future, that houses are going to, there's a bubble or an impending bubble, and we have all kinds of problems with not only the GSEs, but also with FHA. I don't know. It's worth listening to. So I'm not really sure how. I don't know what order they go in. I think we in the industry know that there's we have to have a strong secondary market. It's just essential. We have to have it. And FHA has always been there to help. During the financial crisis in 2008, they were 40% of the market. Not because they wanted to be, but because somebody had to step in and be able to support that market. So I don't know how the order of things will go with the GSEs, but I think the topic is back there. Can we get them out of conservatorship? Calabria says no, they're not strong enough and they can't be removed from conservatorship. But if you also are going to try to change a scoring model in the middle of all of that, I do think that book has to be tested before if you're going to restructure the balance sheet.
Delinquencies pretty much at an all-time low right now. Mortgage delinquencies with a strong labor market. All looks good for Fannie and Freddie. To your point, Teresa, they have repaid and returned billions and billions and billions and billions and billions of dollars to the U.S. government, acting as a massive cash register. And also, to your point, I think a lot of people forget this. Like, it's easy to say, "Oh, get the GSEs out of conservatorship," but that implicit, the government is guaranteeing essentially Fannie and Freddie bonds. That's why 30-year fixed rates were able to reside in the twos, and so many on the call today were able to benefit from that so much last year because of that guarantee. Again, think about it: a U.S. Treasury, 10 years, 3%, about a little less, zero risk, zero prepayment risk, zero Treasury credit risk. So you take away the government guarantee from a mortgage bond, which even with that has prepayment risk and some credit risk, and it's played a huge part, the government conservatorship of Fannie and Freddie, for keeping a healthy housing market. And to your point you made to start it all off, we've seen what has happened in other mortgage markets, when it's just left to the private market. So
I haven't seen a lot of private capital stepping up, as 14 years ago when this all started, and really Congress didn't think. I think they did think that it would be short-lived, the conservatorship. They weren't envisioning this going on and on and on and on until, like I said, they weren't really costing the government anything. They were making money off of the deal. So I don't really think that was the original plan. but I don't see private capital. I don't see a bunch of people saying, yeah, we all want to invest and it's going to be private, when mortgage bonds, I mean, when bond prices were a better return, people say, oh, yeah, maybe I don't want this risk over here in non-QM. Maybe I want to take my money over here. And that's the gamble you run if you try to run a mortgage industry that doesn't have some kind of backing behind it.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, and we have just a couple minutes left with this week's co-host, Western Ohio Mortgage CEO, Teresa Rose. Teresa, question that came in, wasn't the FHFA shift in allowable Fannie Freddie bonds backed by second investments supposed to spur private capital? Great point. To Teresa's point.
Hasn't happened.
Oh yeah, private capital will step right up there and gobble up all that. Matter of fact, the rates will probably be better than Fannie and Freddie's.
No. Well, no, that's just not come to fruition. And as I said, I think we've seen what can happen just in some of the recent things that we've seen in the non-QM market. And I'm not sure that's over. We don't know, right? It's really hard to say what other issues could be lurking out there. And it happens so quickly. You know, it's just overnight, it's just gone. And it happened, you know, with non-QM at the beginning of COVID, much more rapidly than anything with MBS. The private capital was just boom. It was completely gone. You could have had loans ready to go to the table. They weren't going anywhere. It was gone.
And not surprising. Listen, if I was a hedge fund or had millions and millions of dollars, other people, I would not be buying 30-year fixed rate mortgage-backed securities filled with loans in the fives. I can tell you right now. You take away that government guarantee, you know, again, think about what people are buying. They're buying loans. They're buying mortgage loans. There's always risk to that. You like, you know, right now you got a lot of prepay risk with 30-year fixed rates in the fives. You got 40% of economists nationally, they're predicting a recession. With recession comes labor fall off. And with that, we know comes more mortgage delinquency. So a lot of moving parts. And for a mortgage bond to have value, you know, it has to have the appropriate yield. Take away that government guarantee. I've heard people say immediately 100 to 150 basis points in rate.
Yeah.
Without even thinking about it, if you took away that government guarantee.
Yeah, there's no doubt. And you know, the thing with, as we were talking about earlier, just trying to figure out what's next. When have we ever been in an economy where it looks like recession, but we have under 5% unemployment, we have wages that are higher, people are still buying. And I think that the people still buying part is, well, when you put trillions of dollars into the economy, people are going to eventually spend it. And they're spending it now on travel because they've been cooped up in their houses for, 2 years. So it was just that firestorm just waiting to be released. And until all the steam goes, I think we're kind of stuck with it. I personally think, though, that, by Q2 of next year, I think we're going to start to see a little relief. And I'm hoping that this is about a 12-month cycle and that we'll start, we'll get inflation tamed down and we'll start seeing some business as normal. We're not going to see 2021 business. And loan officers that are still holding their breath for that, give me just one more 2021. That's gone. That ship sailed. We might see another refi boom down the road, but it's not coming soon.
We started the show talking about how y'all look back a year and what you have in the mortgage industry is definitely not what you expected a year ago, sometimes better, sometimes worse. But typically the mortgage industry, like they are now, oh, this year is going to be slow and things are going to slowly get better, is aligned on generally where we're going. Right now, though, it is so 50-50 with, essentially 50% of economists predicting a recession and 50% not. Within that, there are divided stances on housing and other things. It is really, it is so, what it reminds me of is the last time we had a lot of government pumping money into the government, quantitative QE1 and QE2 under, I think that was Bernanke as Fed chairman. There was so much back and forth about, oh my God, this is going to create insane inflation. Like nobody bitched about inflation at the beginning of the pandemic. A little bit, some people did. Nobody. At QE1 and QE2, people were up in arms about it. There ended up being zero inflationary tailwinds. Here with the pandemic. Nobody cared. Everybody's just cashing their unemployment checks and games money. And And here we are.
I mean, there's a price to pay. There's a price to pay for printing, as we would call it, printing money. You can't flood the economy. I think that at the heart of it, that people were doing what they thought was best for American families. They didn't want them to suffer. They were seeing people, standing in food lines. People weren't working. We got to help. But you can go too far with it. And I think we've learned that lesson. And it's just going to take a while for that steam to, as I said, that steam to release, and all that pent up anxiety of I got to go buy something going away, and interest rates increasing them. It's really the only way to fight it. That's all the Fed's got to fight it with. So we have to hope for the best and look for good comments from Powell. We'll see. We'll see if he's surprised. I just hope there's no big surprise or any rocking news that we weren't prepared for.
Teresa, always enjoy the conversation with you. As always, very insightful, very entertaining. I always enjoy hearing your perspective on the industry. And thanks for joining me this week.
Thanks for having me. I appreciate it.
And to our attendees, thanks for all the nice comments in the chat, and for 30 minutes of your time. Really appreciate you taking 30 minutes of your time out with us each week. The goal is to have this be a time saving for our listeners, and in 30 minutes to listen and to give perspective on what's been going on in the industry outside of their walls. So thanks for joining us. We're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. Until next Tuesday, have a great rest of the week, everyone. And thanks again, Teresa.
Bye.
Take care.